Hey everyone, Dan here. Today we're going to talk about common misconceptions about short selling. Before we get into it, if you enjoy these videos, please hit the like and subscribe button. It helps a lot. And also feel free to drop a comment below with any additional thoughts, questions, ideas, considerations, what have you. Okay, so I didn't know where to put the screen to start with for this, so I just have it here on the Webull Markets page. But this is now what we're going to look at. So let me just sort of set the stage for why I'm doing this video. Um, the myth that I'm going to focus in on today is the idea that there's a lot of times, especially like midweek during the trading week, I'll start to see messages or comments about folks alluding to something around the idea of yada yada yada. Price is going to go up on Friday because shorts need to close. Shorts need to cover on Friday. And so price is going to skyrocket. I just saw this last night and I was like, my God, I got to do some video about this. I think that the person last night, the one that I saw, was actually talking about Clover. And obviously that's not the case today. We see it coming down almost 3%. So not a great day for Clover. And that's because there's no such thing as shorts need to cover on Friday. So let's go through some sort of helpful articles and I'll kind of like just use them as a backdrop in order to talk about where I think this misconception comes from and the confusion that sort of like, I guess, spreads through the internet these ways. So let's pop over here. How does short selling work? So just sort of like a basic understanding. So somebody wants to sell shares of a stock short. So they ask a broker dealer to borrow a certain amount of shares. There's going to be charges involved, one of which is the percentage fee, the interest to borrow the stock. So taking all of that into consideration, they decide they want to borrow the stock. So they receive those shares that they have borrowed, and then they sell the borrowed stock. And so, you may be buying stock today or any given day that is actually being short sold to you. And then on the short seller side of things, the initial sort of cash benefit that they have is they are provided the funds for the stock that they just sold short. So if they sell 100 shares at $10 a share, then they have $1,000 credit that they're working with now. Their goal then, in step 3, is to buy that stock back at $5 a share, and so costing them $500, and then go ahead and give those back to the broker dealer who loaned them. And of course, there will be, the interest charge and whatever, but they will have netted $500 minus whatever fees they owe the broker. So that's the idea on the short selling side of things. Let's pop over here to just sort of like back up what I had said at the outset. So there are no set rules regarding how long a short sale can last before being closed out. Now, I will temper this with, I believe it was Wednesday, or maybe it was just yesterday, Thursday, there was this new rule that went into effect where shorts are kind of attempting to be strongly incentivized to close out their positions during the day because of the additional requirements of holding something overnight, the additional risk of holding those positions overnight, and even if they have the capital to do so, it's sort of the incentives to close out during the day have been strongly encouraged. Now, whether those things will be adhered to or enforced, or whether it will have any impact on the reality of short sellers and what they want to do versus what they're being incentivized to do, that's yet to be seen. But even though that rule's in place, for the most part, this is still the case. There are no set rules regarding how long a short sale can last before being closed out. It doesn't say should last. It doesn't say, wow, the shorts are really over leveraged. They should really close these positions out. It's just that it can, not that it should. The lender of the shorted shares can request that the shares be returned by the investor at any time. So if I borrow shares from my broker-dealer to sell short, they can at any time with minimal notice say that they need those back. That would then force my hand in purchasing shares at whatever the price is at that point and providing them back. That said, it rarely happens in practice so long as the short seller keeps paying their margin interest. So, surprise, surprise. A broker can force a short position to be closed if the stock rallies strongly. It's far more likely that the investor will close out the position before the lender will force the position closed. Okay, so the big thing here is keep this in mind. So whenever you start to see things floating around of shorts have to close this Friday, shorts have to cover on Friday, the price is going to skyrocket. I think I may know what folks are talking about, and we're going to get to that in a minute. But as you can see here, this is not the case. And even if they're alluding to, which they wouldn't be, the new rules that went into effect, that would apply to any day. Hey, the shorts should be closing out by the end of the day today. They should be, but will they? There's no hard and fast about it. So, additionally, there is no mandated limit to how long a short position may be held. So again, some things that will disincentivize them from holding for a super long time, one of those things being a very high interest fee. So if you see fees in the hundreds of percentage or even sort of like 30, 40, 60%, those things would disincentivize someone from holding a position for a super long period of time. Short selling involves having a broker. Okay, we just went over that. So obviously investors short stocks anticipating that the market price will fall, allowing them to buy back shares like we talked about in the $10 versus $5 example. A stock that doesn't decrease in value quickly enough ends up costing the investor interest. The proceeds of the initial sale go to the investor's account like we talked about, that initial credit of $1,000, and they pay the broker a percentage, which is usually around the US prime rate plus 2%. But like we said, sometimes it can get into the hundreds of percentage points. At any point in time, the investor may buy replacement shares on the open market and return them to the brokerage. If they are able to buy them at a lower price, the investor keeps the difference as a profit. This is the $500 that we talked about in the initial example. If the price is higher, the investor suffers a loss. So they suffer a loss plus the fee that they had to pay, the interest that they had to pay. So in the initial example that I gave, if instead of that price falling down to $5, the price rose to $15, and then they were like, I got to get out of this position, they would buy that for $1,500. So they're already $500 in the red because they only got $1,000 on the outset to when they sold those shares. And so then they can replace those shares back to the broker dealer who lent them to them, but they're $500 underwater plus whatever interest they were having to pay along the way. Okay, so now we're going to flip over to what I think people are talking about. Before I do that, let me just mention a couple of other things. One, I am rolling out a newsletter in the coming months. This isn't anything that's happening imminently, but I'm collecting emails for the time being. So if you would like another way to stay in touch beyond these videos, I'm thinking once or twice a week, I would send an email with additional sort of strategies, interesting potential breakouts that I see, some possible plays, and all of the details. Throw your email into the Google form. That link is in the description. And when I roll it out, then I'll sort of like send something saying like, hey, this is launching. Opt out if you've changed your mind. And then the other two things are, if you're looking for brokers to use, I have a couple of great free brokers linked in the description. One is Gatsby. That is on your mobile device, really simple to use, really easy, quick transaction times, and it's very, very simple, very modern UI and UX. The other one is Webull, which is the charting software that I use, and also obviously they are a broker. Both are free. Webull has a ton of different opportunities for different trade strategies, and but both do options, both do shares. You can do spreads, stuff like that. So links in the description below if you're interested in those things. Okay, so what I think folks may be talking about, if there is anything in reality that they're basing this, shorts have to close on Friday kind of mantra, is potentially options. So options are different than shorting a stock. This, I remember, was a huge talking point on Wall Street Bets when the market was crashing, when the COVID scare happened, and everyone was like, "Oh, they should ban short selling. They should ban short selling." And people started to be like, "What? I don't want to not be able to buy put options." And the moderators had to come in and say, "Hey, when they talk about banning short selling, buying put options is not short selling. What you're doing when you're buying a put option is you are buying allows the holder to sell an asset at a certain price within a specific period of time." So what that looks like is like this. If I want to buy puts, I'm going to say buy June 20, well, we shouldn't use today. Buy next Friday, July 2nd. What are we on? Clover? If Clover is trading below $13, I have the right to have somebody purchase those shares from me, 100 shares per contract, for $13. So even if it's at $10 a share by then, if this trade expires in the money and Clover's trading at 10 and you have purchased this put option for $13, then whoever sold it to me, I can say, okay, so you need to buy these at $13, even though $13 a share, even though it's only worth $10 a share right now. And so that's what that is. And on the other side of things is obviously buying a call where you think the price will rise. So buying a put, you think that the price will go down, and those contracts become worth higher value as the price does decrease, and call options increase in value as the price increases. Now, that's a vast oversimplification. It does depend how close to the expiration you are, what the implied volatility is, a bunch of things. But very broadly speaking, again, this isn't meant to be an options class. This is just to say this might be what people are talking about, and here's why. And so the reason that I say this is because people are always pointing to Fridays. I always see this thing about, shorts need to cover by blah, 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 Friday, something, something date. It's always on Friday. So that's what makes me think that folks are actually thinking of options, contracts that are expiring. Now, the way in which they could be kind of right, but again, I don't think that this is what people are talking about. If I were to sell a call option and I didn't have the shares to sell that call option. So if I have 100 shares of Clover and I sell a call option, that's called selling a covered call. So I already have those 100 shares. So if somebody calls them away from me, if somebody sort of executes that contract, then I would pass over my 100 shares to them. I wouldn't have to do anything else. But if I sold them that call and it expires in the money and I owe them 100 shares, then sure, I would technically have to go buy 100 shares and then give them to them at the price at which we agreed upon. So in that way, folks who are short a position because they've sold a call, it's not a short sale, but they are short a position because they sold a call. Those folks, if they've sold it without already having the shares, to be able to pass over to the buyer of the call option, they could on Friday, if the call's in the money and it's looking like it's going to expire in the money, they could have to go buy 100 shares or however many contracts they have in order to cover those positions. And so that when those come due after the close of the markets and those things start to process, they would have the shares to be able to pass over to the buyer of the call option. So That's the only thing but that's a different thing than saying short sellers have to cover. Again, that's not a short seller is not someone who's who's selling call options. Those are often people who are like wheeling, like selling covered calls and selling cash secured puts, which is a totally different thing. And you can find plenty of videos online about that. So while it is technically a short position, it's not short selling. So, but that's the only way in which there could be a bunch of like buys coming in that have something to do with a Friday and an expiration dates, and for some reason needing to cover their position would be if they had sort of like nakedly sold uncovered calls. Naked and uncovered is kind of redundant, but all right, well, that will do it for this video. The main point here is what we said back here. There are no set rules regarding how long a short sale can last before being closed out. So if you see these things floating around that are, hey, price is going to run up this Friday because the shorts have to cover, I don't know what those people are talking about. If you think you do, feel free to drop a comment below. But just be aware that that's not a thing. And so if you're sinking a bunch of money in on Thursday night or buying a bunch of call options on Thursday because Friday the price is going to explode because, shorts have to cover, like just do your own due diligence beyond this video, but at least let this be a trigger point and say, hey, I should go research what those folks might be talking about and if there's any validity behind those claims, because if not, then I'm basing my decisions on things that just are fundamentally incorrect, and so there's not going to be any way for me to win in that position unless it's just pure dumb luck, and in that case it's not repeatable, and so it's not something worth kind of executing on repeatedly. Okay, well, I hope your trading week has gone well, and I appreciate you watching the video, and I will see you in the next one.